Most of the time, option buyers are always the losers. Why is that so? So let's try to understand from both buyers and sellers' point of view. Let's put a question straight away. Who makes more money in this market? Option buyer or option sellers? Let us try to understand this. Welcome to my channel, Pivot Points with RK. This is Ramesh Krishna. See, most of the time, option buyers are always losing money, whereas option sellers they have an hedge of making profits most of the time. So let's try to understand why is that so. Option trading is a fascinating activity and you can earn good profits if you do it carefully. You can either buy options or sell them depending on what your view of the underlying is. However, one question that puzzles many is who makes more money, the option buyer or option seller. As you know, the stock market is always a zero sum game. It means that either the buyer or the seller can make a profit, but not both. The amount of profits gets transferred from the party making a loss to the one that is making a profit. Because in the stock market, nobody else gives you the money. Somebody has to buy at certain price and he has to sell it at certain price. When he buys it at certain price, he is buying it from somebody at an X price, and when he tries to sell it, he will sell it at Y price to another Z person. So likewise, it just keeps on transferring. So one person makes profit, other person loses money. One person loses money, again this makes sense. So stock market when it's going up and down, so there is always a game sum. It's sometimes it's called zero sum game. So one is earning money and one is losing money. It can be vice versa. That's why most of the time, if you see on end of the month or end of the day or end of the year, and our P&L shows that up and down, up and down, up and down, and only some big players are even the people who know the stock market very well. They are in the profit at the end of the day or end of the month or end of the year. That's how it happens. Let's try to understand further. So, who are option buyers and who are option sellers? Payoff an option buyer can make limited losses, that is the premium paid, but his profits are unlimited. On the other hand, an option seller can make limited profits up to the premium paid, but he or she stands the risk of getting unlimited losses. Who earns more in the long run? In the long run, the probability that both the buyer and seller will make money must be equal. This is because if only the buyers make money, then nobody will sell options, and if the sellers make money, then nobody will buy options. From our experience, we have seen that the seller of options makes profit more frequently, but he earns small amounts every time, and the buyer of options earns larger profits from each winning trade, but he wins less frequently. In other words, it is possible that the option seller may earn rupees 100 for 5 times. So this portion, the option seller earning 100 for 5 times, and option buyer is likely to make profit of rupees 500 from one trade. We will try to understand from a worksheet that I'll let you know about that. In the long run, the seller makes profits from more trades than the other buyer, than the option buyer, but their amount of profit earned by them are similar. So, should we be an option buyer or an option seller? So, there is a straightforward answer to this question since it all depends on the risk appetite of the option trader. If you are interested in making big profits from one trade, then you should go for buying options. If you are satisfied with making small profits multiple times consistently, then you can sell options. You must remember that you will be assuming a payoff profile or limited profits and unlimited losses if you sell options. Hence, you will have to always maintain a strict stop loss to avoid facing huge losses, because if you look at the option seller when he sells so minimum quantity, he has to spend nearly 20 to 20 times of an option premium. That I will show you in a work Excel sheet. How is that going to happen? Many option buyers aim for big profits and end up losing the premium when their view goes wrong. So over a 6-month period, it may happen that in the first 5 months they lose the premium, get demotivated and exit the market. However, in the sixth month, if the market moves up, they do not earn big profit since they are out of the market, because by then probably most of retailers would have lost most of their capital and only they are left with very small capital. With that, they will not be able to even take big trades, but they'll start again losing the money or making a small profits. That's how it happens in over a period of time. If retailers do over trading, if they don't have proper stop loss, proper risk management, proper trading psychology, they will end up losing the money. On the other hand, the option sellers get a chance to make profits more frequently. This is because as time passes by, there is a decay in the time value of the options. So the option seller can hold a position and make small profits frequently. This portion we will try to understand why in the long run option sellers are going to make money, whereas option buyers are going to lose the money. That we will try to understand from this point of view, especially the time decay. Let's understand from this the Excel sheet for the last 1 year data. If you look at this data, nearly it's a 250 days trading days, 247 trading days from last November 22nd to last November 21st, 22 to till date. For nearly 247 days, the trade happened. And if we see the points for the last 1 year, the market moved from 42,387, the close was 42,347, to current price is around 43,585. The difference is 1,238 points. If you look at this, for the last 248 days, the points moved is 1238, 1,238 points. That means most part of the day, most of the days, the markets are only sideways. As I mean, generally it has been said that 60 to 70% of the trading days are on the sideways, and only 25 to 30%, 30% nearly 30% of the trading days could be trending days, either upward or in the downward. But most part of the time, it's sideways market. That's the reason why if you look at that, on an average, if we see daily movement of the points is only less than 5 points. If you divide this 1238 days, 1238 points by 247 days, we'll get less than 5 points per day. The movement of the points is 5 points per day. So what happens here when option sellers are selling with their huge money, only the FIs and DAs are able to sell that. That data also we will look at it. See, this is the FII data, FII data, DA activity. If you look at this data, we will see in the index options, especially in the index options, which is Nifty and Bank Nifty options, index options, the kind of money they are investing in this. If you look at this cash market, they are buying either at less than 500 crores or selling it at less than 500 crores. Say as of a 17th date, 17th November date, it's minus 477 crore they have sold. DI data is this. Index futures, if you look at it, 638 crores are the future contracts. But if you look at index options, in the index options you see this 9,670 crores they have sold. If you look at this, this is almost 20 times of this cash market price. So you can just imagine the kind of money they are investing in selling options. See, if they want to sell these options, they need at least 22 times money than the buyer's premium. So if you look at this 9,670 divided by 20 times, it is less than 450 crores. So these 450 crores are the option buyers. The data I will show you how it works out to be. In this Excel sheet, I've just worked out with small working data. For example, in a particular day, an option in the Bank Nifty option, I've taken example of a Bank Nifty option, trading price is around 300 rupees. To buy 300 rupees premium of 30 quantity, I've taken as 30 quantity. Currently, it's a 15 one lot and two lots are 30 quantity. So I'm taking 30 quantity. To buy 30 quantity of 300 rupees price, I need just 9,000 rupees as an option buyer. Whereas as an option seller, I need to have 1,94,000 rupees to sell two lots of Bank Nifty, which is 30 quantity, which is roughly 22 times of this premium. 300 into 22 is 6,467, whereas the option seller is spending 6,467 rupees per quantity, which is 1,94,000 rupees for a quantity of 30. Option seller is 9,000. So now assuming on the investment of this, if both the seller and the buyer are looking at a profit of 40 points, the roughly the profit amount would be 1,200 rupees. 1,200 rupees with an investment of 1,94,000 rupees, and option seller is making just less than 1%, which is 0.6% of his investment, whereas an option buyer is making 13% on his investment, which is 300 rupees. If he makes 1,200 rupees on 9,000 rupees, he is making a 13% on his investment. So you can just imagine from this data that how the sellers, by investing such a big amount like this, see here on 17th day the sell option index option selling happened worth of 9,670. If you look at this data on 16th, it is very less. Index futures, they purchased some 1,573 worth the contract crore. These values are in terms of crores. 9,670 crore worth of index options they have sold on 17th, and they have both sold in the cash market, which is typically Nifty or Bank Nifty or any stocks, any stocks in IT or Bank Nifty, whichever stock. They have sold 477 crore worth of stocks. When you see these few data, you can just imagine these are the underlying assets. The cash markets are underlying assets, and they are betting very huge money like this on the underlying assets. Why is it so? Because they have a very big hedge. By investing this big money, they want to earn something like some money which is slightly higher than the regular interest rates. That's how they trade. The FIs have not invested this big money in this market just to take away a big profit, just like how retailers are expecting. Where retailers, just like us, we expect by investing 1 lakh rupees and every day we want to make a 10,000 rupees profit, at least 10% of that. Wherein the big investors like this, they do not expect making big profits, rather they expect slightly higher than the bank interest rate or something like that. By investing 1 lakh rupees, they don't expect to make 10,000 rupees in every month. Even by investing 1 lakh rupees, just an example, rough an example, by investing 1 lakh rupees, even if they make just 1% or 2% in a day trade daily or a weekly, that's fairly good enough for them, because end of the month, even if they could make just 5 to 6% on their investment, that will be quite big enough. Whereas retail investors, they cannot survive. In fact, they don't want to survive 5% to 6% on their investment. Even they don't even think of making such lesser profit, 5 to 6% on their money. That is where most retailers fail in understanding the market, and they go for trading in options and they start losing money. So something like this data, let's try to understand this data. Wednesday 15 November, which was Wednesday, that was in weekly expiry. If you look at this weekly expiry, the data, The cash market, they have purchased 550 crores worth in FIs. At the same time, FIs, they have sold 58,745 crores worth of index options. This index options are just Nifty and Bank Nifty or Fin Nifty, something like that. It's 80%, more than 80 to 90% are Nifty and Bank Nifty. Out of that, purely Bank Nifty has got more share on that. If you look at this data, what do you understand from this? See, these are the underlying cash market. The underlying cash market, they are betting on this underlying cash market with this huge money. So, don't you think that these FIs and EAs, preferably if you compare here, the FIs are investing more money on options and index to how they can control the cash market with this kind of money. Can I just imagine this? And again, in this index options, there are both sellers, bears, and bulls. That means both are sellers. Some are more bullish and some are more bearish. It's typically fight between these two big bulls and big bears. So that's how like this. So if you look at this kind of a data, what do you get from this data? Index options or option buying and selling is a big game in the Indian market. Wherever for that matter is across the world. If you look at in our Indian market, if you see that every day the cash market amount is something like this, and option trading value, you look at this value. See, likewise, even 13th, that is on Monday, 13th November, index options, if you look at this 18,000 crore. If you look at the cash market, just 1,244 crore they sold and 18,000 crore worth of option they've sold. So why this so much? Because they are the sellers. They are the big sellers. They have got huge money and they sell. Whereas retailers, they can afford to buy the. Suppose if you want to buy some 1,000 quantity of 300 rupees, you just have to spend 300 rupees into 1,000 is 3 lakh rupees. For the same 300,000 quantity, the FIs may have to spend huge money. In this data, if you see, they have to spend huge money. Okay, I hope you are able to understand this. See, if you look at the market data, everyday data, this is everyday data, 100 points up and 100 points down, and in the few days, very few days, where the market moves in a big market gives you a big momentum. 500 points to 700 points high or 500 to 700 points low. Otherwise, most of the days it just goes up and comes down, goes up and comes down, and most of the days are sideways. With this kind of data, you can make out that how option sellers, with the option of that time decay, how they can make money, big money on this. See, this is how that. In other words, it's possible that the option seller may earn 100 rupees for 5 times, because since they make very less profit in every trade, they concentrate more on number of trades than few numbers. Whereas option buyer is likely to make profit rupees 500. He's always expecting by investing 300 rupees per premium, he always expect at least more than 10% profit in the first trade, every trade. But in case of the market goes against his direction, or if it doesn't move in his direction, there are two ways. One, if it doesn't move in his direction, even if it just goes down, he'll lose money, buyers will lose money. Or if it stays in the same level, it's in sideways, there also option buyer would lose the money. That is why the most of the days option buyers when they do this over trading, they end up losing all their capital. So only with this, when you try to understand the kind of money they are investing on this and the kind of data, what every day the market moves, like 100 points up and 100 points down, 100 points up and 100 points down. One day 200 points, see one day 350 points down, other day 450, another 394 points up, 218 points up, something like this. So one day up and one day down, one day up and one day down. So end of the day, for a year, there hardly was any movement, which is around 1,038 points, which is almost less than even 0.1%, something like that on this movement. So less than 5 points. Every day movement, if you look at it, it's a 5 points, that's all. So, so as we say, now the stock market is always a zero-sum game. It means that either the buyer or the seller can make a profit. When the option buyer makes a profit, he will make big profit, of course. But on everyday basis, buyer may not be able to make big profit, whereas the seller, he may not make big profit, but he keeps making smaller profit consistently throughout the trading days. That is where he ends up in making consistent profit, accumulating cumulative profit. That's where the option seller makes consistent profit, whereas option buyers, most of the option buyers, they lose money heavily because of over trading, because every single candle or every single data he tries to make money. It's very tempting. He keeps investing, he keeps buying option, and in the moment he buys an option, he it goes against his direction, and his stop loss gets hit, or he will start waiting for the market to move up and to cover up his losses and to start giving a profit. It may not happen in the market. So with all this data, what do we understand is that you look at on 8th November, 8th November data is this. If you see, they hardly have sold 84,000 crores worth the cash market, the FIs. But if you look at the index option, they have sold 32,000 crores worth of options. See, when they buy very least options, right? Because they are not very big buyers. Must see, once they sold, they have to buy. But generally, what happens when they have sold, they don't have to buy on the expiry date. That is where we get this data, 32,000 crore. We may be thinking that to get this data, since they have sold at some price, they have to purchase it back. But they don't have to purchase on the expiry date. They can leave it as, because most of the time the option price goes down below zero, or even just at zero, or even 5 paisa or 10 paisa, something like that. Since they have already paid the STT, all the other taxes on the selling side, so they don't have to square it off for buying. So they can just leave it as it is. So that's where that it looks like this, no? And not only that, on the trading day when they sell, for example, 300 rupees worth option they sold, but when they buy it back, they buy it at less than 5 paisa or 10 paisa. Because of that, since they sold at 300 rupees and they bought it at 5 paisa, it's almost net sale is 299.5 paisa, 299 rupees 5 paisa. That's how the net sold is this price, because they are the one who is making big profit here. If in case if the trade goes against this, they would have bought the stock. For example, the stocks which they have sold at 300 rupees, all those options, if they had gone up to even 400 rupees, they should purchase it at a high price. So then this would come positive. That means 58,000 crore worth stock when they sold it, If the prices have gone up, and even at the 10, 100 points, something like that, then their purchase rate would become positive. But it's not the case, because this index options sellers are two groups, bear and bull. Both of them are sellers. Both of them have sold heavily. And end of the day, when the index, either it's a bank nifty or nifty, doesn't go trending day, it just goes in sideways, and end of the day at 315 or 320, when it closes in between, both bulls and bears who have sold on both sides would make their money like this, because they have sold at 300 rupees and they bought it at 5 paisa, 10 paisa, 1 rupee, something, whatever price at that closing price, they would have bought at that price. That is why the net sale, a net sold value is this big sale, 58,000 crores 745 on that day. So I hope you can understand from this data how they sell options and they make big money. I hope you understand this data, especially these kind of data. When you understand this, 58,000 crores 745 rupees, they have sold at the time of market opening or during the market hours. But end of the day, trading day closing time, all those option prices, most of the option prices, out of the money option prices like PE or CE prices, would narrow down to 5 paisa, 10 paisa, or even 0, or almost less than 1 rupee, something like that, that they have purchased it. So the net sold is 300 minus 5 paisa. If you take one for one particular premium, one particular option, 300 rupees and 5 paisa, and the net sold is 299.5, something like that. So with this kind of a data, when you see on a daily trade how much quantity they have sold, based on that, this is the money that they are making. So most of the retailers or most of the option buyers, if they don't trade properly, because generally the data shows 60 to 70% or 60 to 70% winning trades are with the sellers, only 30%, less than 30% or 35% winning side is to the buyers. So that means to say, out of 10 days, 10 trades or 10 days or 100 days, something like that, even if you calculate, option sellers make a small profit with the kind of investment they do, and they work out on a slightly kind of a higher interest rate, something like that. They work out on that kind of a data. So thousands of crore rupees, instead of investing in the bank or instead of investing in some other assets, when they trade this money, invest in money and trade, make the trades here, they would expect slightly better interest rate than the banks or any other investment. That's how they do consistent profits and they make consistent money end of the day. Whereas buyers who come with a small capital, compared to they may have a big capital, but compared to the these big investors like an FIS, DIS, retailers capital is very, very, very less. So they expect making more money, but end of the day, by trading in the options, when they do chasing the market, they start losing a lot of money. Even they make five trades profit or even 10 trade losses, end of the day still they lose capital. And the very few retailers who are well versed with the market and who have very good control of their emotions, who are very disciplined and who knows how to manage their emotions and how to do risk and reward analysis, only such people can make money. So the traders, try to understand this, try to learn the market as much as possible, stay in the market, and don't lose big money. Trade with a limited trades. Just plan your trade and execute the trade. Stick to your trading strategy. Plan your trade and trade your plan. This basic rule, just stick to this rule. Every day you mark your support and resistance level and see the market trend in which direction it's going, and accordingly try to initiate your trade. And every trade is involved in a risk, and every trade when you take, every trade, it can go either in your direction or against your direction, or it may just go sideways. But in trading options, when the market goes in sideways, the buyers start losing the money. But not in the case of stocks. If you invest in cash market, like any other stocks or blue chip stocks, you may not lose money just like in the options. So, but try to learn this price action, chart movement, and all such things with the cash market by trading small quantity in the stocks. And then once you get hang of that chart patterns and price action, then you get into option market, because in option it's more riskier than the cash market, just investing in the stock or trading in the stock. So I hope you are able to understand something from this. I'll keep you posted or updated much more details like this, and join me daily on live trading. Subscribe my channel to get updated like this. I hope you're able to understand this concept on how most of the time the option buyers are losing money, and whereas option sellers are consistently making small profits but in the longer run. Okay, I hope I could make you understand the basic concept. Just like this FI data, you can also log on to this website and get a lot of data and analyze the data daily. And charts also you can analyze on the trading view. Okay, thank you. Please subscribe my channel and press like button, get notification instantly when I post the data. Try to be connected with me for daily live trading. Thank you.